We're living through some really challenging economic times right now, with high inflation continuing to squeeze our budgets. Interest rates have been rising too to try and bring inflation under control. All this macroeconomic uncertainty means we need to be smart about how we manage our investments and savings. So with that in mind, let's dive right into top 5 investment strategies for the year ahead. Number 5. Dollar cost averaging into index funds. In volatile markets, one of the safest strategies is dollar cost averaging. This simply means investing a fixed amount on a regular basis, like every month, rather than trying to time the market ups and downs. Index funds are a great choice for dollar cost averaging because they provide broad market exposure at very low costs. Some top options to consider are S&P 500 index funds for U.S. stock exposure, or total stock market index funds that cover all types of publicly traded companies. By regularly investing small amounts regardless of price swings, dollar cost averaging helps alleviate worries about buying at the top. Studies have repeatedly shown that investors who stick with a disciplined investing plan over the long run tend to do better than those who try to constantly reposition based on short-term market movements. Number 4. Invest in dividend growers. When inflation is high and interest rates are rising, look for stocks that not only hold up well fundamentally, but also pay reliable dividends. Dividend-paying companies tend to be more stable than those focused solely on capital gains. Within the dividend universe, target companies that have a history of regularly increasing their payouts every year. Such dividend growth stocks like Microsoft, Nike, PepsiCo, and Johnson & Johnson are often leaders in their industries, with strong corporate management focused on long-term value creation. Even if their share prices fluctuate, the growing dividend income can help offset inflation's impact on your purchasing power over the long haul. Just be sure to reinvest those dividends to maximize your returns. In addition, dividend growers are less impacted by market volatility and tend to hold up better than non-dividend payers during periods of economic uncertainty. Their steady dividend payouts provide a consistent income stream that can boost total returns. Number 3. Consider short-term bonds. During periods of economic uncertainty and rising interest rates, longer-term bonds become more vulnerable to price declines. That's why it makes sense to favor shorter-term bonds or bond funds with maturities under 3 years right now. Bonds with close maturity dates aren't as rate-sensitive and can provide some portfolio balance against equity volatility. Just bear in mind that yields will be relatively low given the current rate environment. Total return will come more from price stability than income at this point in the cycle. Short-term bonds are a safer investment option during unstable markets. They carry lower interest rate risk than long-term bonds. Since short-term bonds mature in a few years, investors are less exposed to fluctuations in bond prices due to changes in interest rates. Having a portfolio tilted towards short-term bonds can help reduce overall volatility and risk for conservative investors. Number 2. Analyze opportunities selectively. While broad indexes capture the overall market, don't forget about selectively adding other investments that may benefit from economic and social trends. Some ideas worth considering: industries like renewable energy, cybersecurity, healthcare innovation, e-commerce, or specific companies aggressively buying back stock. Doing your own research on specific stocks or industries expected to outperform can enhance returns. Just keep position sizes tiny and diversified, as more narrowly focused picks carry greater risk than broad market funds. Active selection of the right opportunities may boost portfolio returns over the long haul. Number 1. Maintain cash reserves. No one can predict exactly what 2024 will bring, but given all the macro turbulence, it makes sense to keep some powder dry in the form of cash reserves. Emergency funds equal to 3 to 6 months of living expenses are always prudent. Beyond that, maintain enough liquid reserves to nibble at attractive investment opportunities should sharp market pullbacks occur. Times of high volatility can present buying opportunities for long-term investors with a cast iron constitution. Cash flexibility allows you to be ready to deploy capital when others are panicking. It's also important to regularly reevaluate any selective stock or sector picks to ensure they still align with your investment goals and risk tolerance. Markets and companies are constantly evolving. What was once a promising high-growth opportunity may manifest risks over time. Well, those are the top 5 investment strategies above all. Keeping a well-diversified, low-cost portfolio tailored to your objectives and risk tolerance is key. Stay disciplined, ignore short-term noise, and remember, time in the market tends to beat timing the market over the long run. We hope you found this video helpful. Let us know if you have any other questions in the comments below, and don't forget to hit that like and subscribe buttons below.